Followed by a Q&A session. Before we begin today's conference call, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve risk and uncertainties. Please refer to the slide number 23 of the investor presentation for a detailed disclaimer. ICRA or any of its subsidiaries or the directors, officers or employees of ICRA or its subsidiaries shall have no liability whatsoever for any loss howsoever arising from any forward-looking statements or use of the investor presentation or its contents or otherwise arising in connection with this conference call. Now, I would like to hand the conference call over to Mr. Ramnath Krishnan, Managing Director and Group CEO, ICRA Ltd, to commence the proceedings. Thank you, and over to you, sir.
Thank you, operator, and good afternoon, everyone. Very warm welcome to today's Analyst Investor Call. I will commence by providing you broad highlights of our financial performance for the financial year 2024. I'm delighted to say ICRA as a group has delivered strong results in the financial year ending March 2024. The overall top-line growth was 10.6% at a consolidated level. Ratings business delivered a growth of 12% year-on-year, and the analytics business, which is our non-ratings business, delivered a growth of 8.6% year-on-year. Despite significant investment in our people, technology, and related infrastructure, we were able to deliver a strong growth in our profit after tax by 11.3%. I'm pleased to advise that the board has recommended, subject to shareholders' approval, a dividend of 100 rupees per share, which includes a special dividend of 60 rupees a share. In recent years, we've undergone a transformative journey, bolstering our credibility and fortifying our processes, enhancing our people strengths and insights. Through investments in cutting-edge technology, we've become more agile, while our talent development initiatives have ensured a diverse and empowered workforce. With analytics delivering on our imperatives and driving our growth, we are shaping a future-ready business in a data-driven world, catering to both domestic and global clients with customized solutions. Moving ahead, we are excited to announce that Pragati Development Consulting Services Limited, which is a subsidiary of ICRA Ltd, has received SEBI's approval for registration as Category 1 ESG rating provider. We recognize environmental, social, and governance areas as a core growth areas for us and are committed to integrating ESG principles into our operations and services. This development positions ICRA Group among the few entities offering holistic risk management solutions, including ESG ratings and scores. We are also excited about the prospects of our acquisition of D2K Technologies, a company that we acquired 60% of in November of 2023, which aims to transform ICRA Analytics into a diversified product company. As we reflect on the past year, we remain committed to our mission of providing superior ratings and comprehensive financial services to our clients, both within the country and outside. We will continue to pursue organic and inorganic growth opportunities, focusing on both expansion and sustainability, while nurturing talent and leveraging technology to drive our success. On the near-term outlook, GDP growth outcomes remained healthy in the last financial year, benefiting from robust government capital spending, buoyant, albeit uneven urban demand, and services exports. At the same time, an unfavorable monsoon in 2023 dampened the output of most major crops and infused caution into rural demand. Notwithstanding healthy capacity utilization, private investment remained modest compared to the exuberance seen in the previous cycles. Based on these factors, GDP growth is estimated at 7.8% in the last financial year. ICRA is, however, watchful about the momentum of economic activity in the first half of this financial year, that is FY 2025, stemming from potential slowdown in government capex during the general elections and the monsoon period, weakness in merchandise export growth, and dissipation of the benefit of deflation in global commodity prices. We expect GDP growth to print below 6.5% in the first half of this financial year, before improving to 7.2% in the second half, aided by back-ended government capex, likely pickup in private capex, improved rural demand if the monsoon turns out to be favorable, and some pickup in export growth. Overall, ICRA expects the GDP growth to land at 6.5% in this financial year. I will now hand you over to Mr. Venkatesh Viswanathan, our Group CFO, to take you through the FY24 performance in greater detail. Over to you, Venkat.
Thanks, Ram. Hi, everyone. I will be covering the financial section of the presentation, which is slide number 8 and 9. Starting with Q4FY2024, consolidated revenue from operations increased 13.7% to rupees 124 crores for the quarter, driven by strong growth of 13% plus from both ratings and analytics. Profit after tax for the quarter increased by 22% to rupees 47.1 crore. Full year 2024, consolidated revenue from operations increased 10.6% to rupees 446.1 crore for the full year ended March 31, 2024. Ratings delivered strong growth of 12%, whereas analytics grew by 8.6%. ICRA Ratings delivered strong revenue growth as bond issuances, bank credit and securitization continued their healthy growth trajectory. ICRA Analytics growth was driven by a focus on growing our core banking and risk business and the recent acquisition of B2K Technologies. Overall expenses for the year includes impact of consolidation of B2K for 5 months, arbitral award, and B2K acquisition costs. Profit after tax increased by 11.3% to rupees 152.2 crores for the year. As informed by Ram earlier, we have declared a dividend of rupees 100 per share, and we will continue to reward shareholders on a consistent basis. That's all from the finance section. I now hand it to Shivkumar to take over the balance part of the proceedings.
Thank you, Venkat. Good afternoon, everyone. I will now provide an overview of ICRA's ratings business. I will do this in 2 parts. Firstly, I will talk about the business environment that we saw in FY24, and then the outlook for the same for the current year, that is FY25. So firstly, the business environment in FY24. Both the bank credit outstanding as well as bond issuances grew significantly at 16.3% and 17.2% respectively in FY24 year on year, as the overall cost of borrowing in the global market remained elevated and large corporates prefer to borrow domestically. On an incremental flow basis, the bank credit reached an all-time high level, and so did the domestic corporate bond issuances. A buoyant economy supported by government's infrastructure spending and urban consumption supported the demand for credit. Given the government's thrust areas, expectedly the infrastructure and the iron and steel sectors led the incremental bank credit growth in the industry segment. Likewise, bank credit outstanding to medium and small industrial sector grew at a faster clip than the large industrial sector. Credits to NBFCs and personal loan segments, incremental bank credit, though it moderated over the previous year as RBI increased the risk weights on bank lending to these segments in the later part of FY24 as well, as due to the merger of a large housing finance company with a bank in FY24. Tighter liquidity conditions in the middle of the year to tame inflation also did its bit to moderate the bank credit growth. Bond issuances grew significantly in the first and the fourth quarter of FY24 as the yields moderated. Overall, the growth happened across all segments, that is banks, corporates, and NBFCs. Banks issued bonds to fund their own credit growth, while corporates and NBFCs took benefit of moderate yields. Commercial paper outstanding grew 9.9% on year as security broking firms issued commercial paper to fund their working capital requirements and margin trading facility. Securitization volumes in the market are estimated to have grown at about 25%, which is after excluding the impact of a large HFC that exited. Existing large originators securitized higher volumes, and new originators also came in as NBFCs and HFCs grew their book, significantly driven by an uptick in consumption. ICRA's revenue growth in FY24 reflects the trends in bank credit growth and market debt that I just mentioned. Now let me move to the outlook for FY25. We do not give future guidance. I will, however, talk about the key drivers for our business. Bank credit growth may face some headwinds with higher risk weights for certain high growth consumption segments, as well as their elevated credit to deposit ratio, for which the regulator has expressed some concern. Bond issuances are likely to benefit from competitive funding costs domestically, which may additionally be supported by a possible rate cut by RBI sometimes later in FY25. Geopolitical challenges are quite likely to keep global borrowing options dearer. Growth in securitization would depend on the extent to which NBFCs and HFCs are able to grow their book. Given the higher risk weights for on-balance sheet lending to NBFCs, securitization could become a preferred funding source for NBFCs. Government's continued thrust on infrastructure, private sector capex in select sectors, pickup in exports, and the interest rate trajectory would be critical for a sustained growth in credit market. That is all from my side. I would now hand you over to K. Ravichandran, our Chief Rating Officer. Thank you.
Thanks, Shiv. Good afternoon to everyone. Over the next 2 minutes, I'll be covering the performance update on rating operations. We finished the year FY24 with further improvement in the rating accuracy metric, namely average default position or ADP. The ADP print was 94% for the just concluded fiscal, which was 93.3% in the previous year, and against a long period average of 76%. The higher the ADP, the more accurate are our ratings collectively. Other rating accuracy metrics, namely cumulative default rate and rating stability, are also seen to be improving consistently over the past few years, and FY24 was no exception. The number of instances of defaults dipped to 5 in FY24, compared with 22 in FY23 and 42 in FY22. The severity of rating actions as measured by the large rating change rate also reduced to 0.7% in FY24 from 1.4% in FY23 and 2.3% in FY22. You can refer to the website under rating performance for granular details. It's our endeavor to maintain such rating accuracy level in the coming years. Moving to other performance trends. The rating action trends in FY24 marked the normalization of the rating change rate with the proportion of rating reaffirmations at 80%, converging with the past 10-year average. The reaffirmation rate had been between 75 to 78% in the preceding 2 fiscals. In FY24, ICRA upgraded 2 entities for every entity downgraded, in continuation of the upgrade momentum that had been set in motion in FY22 on the heels of the first year of the pandemic. Also, a large majority of rating upgrades were driven by company-specific factors such as expansion in market share or order book, improvement in the cost structure, reduction in project risk, or fresh equity infusion that strengthened the balance sheet. Aviation, hospitality, auto and auto components, and banks were the only few sectors in FY24 where the upgrades are mostly induced by industry tailwinds. ICRA rated several novel transactions, with the notable ones being the first rating assignment by a CRA for a leveraged AIF, securitization transaction of a NBFC, where the pool was part of overseas bond transaction the receivables from the pool being the security, and the first InvIT in education infrastructure space in the country based on securitization of rental receipts. ICRA continues to be the preferred CRA amongst leading issuers in the securitization space. The company also maintained its leading position in the BFSI space, where it added marquee clients, including through new generation brokerage houses and NBFCs. On the corporate sector front, renewable energy, roads, and EV sectors saw additional marquee clients. ICRA continued to expand its research and initiate strategic market outreach and events in H2. The company initiated 13 webinars on various focus sectors and participated in 40 market events with top leaders during the off-year. Some of the notable webinars were on medium and small NBFCs, renewable energy, specialty chemicals, automobiles, and hospitality sectors, which saw overwhelming participation from the investors, lenders, and industry participants. With these remarks, let me hand over the floor to Jayanta Chatterjee, MD of ICRA Analytics Limited. Thank you.
Thank you, Ravi. Good evening, everybody. I shall take the opportunity to share an overview of the business of ICRA Analytics Limited, IAL for short, which we refer to as the non-rating business of the group. For each of the three businesses of IAL, I will cover the current environment in H2 FY24 and also briefly touch upon the outlook. Knowledge services is our largest vertical, and in H2 FY24 it continued to drive growth for IAL. Although inflationary pressures continued, we were able to further expand our value-added services for our anchor client. We expect that focus will remain on business transformation, data analytics, and technology services. Our clients' businesses would be driven by increased demand for fintech skills in the issuer side of the structured finance business, business transformation projects work, and sign-off work in rating support. Moving over to our second business vertical, which is market data, we saw strong regulatory push for stress testing, risk management, data transparency, and reporting, which continued to drive volumes for H2 FY24. Here we expanded our coverage during the period to provide newer services like stress testing and also enter into tie-ups with global data providers like FactSet, Bloomberg, Moody's Analytics, and with ICE to service other larger markets, including global markets. The outlook remains robust, driven by trends towards cloud-based information tools and related data products, and more of value-added services rather than pure data. This is expected to drive consolidation of our services and products going forward. Coming to our third business, which is risk management. This was driven by increasing spends from banks on the risk management solutions that we saw during the year, and there was a robust growth in this segment during H2 FY24 and particularly Q4 FY24. The NBFC segment also witnessed good demand in H2 and Q4. Acquisition of D2K, which has sophisticated tools for credit monitoring and early warning signals, has further strengthened our position in the risk management segment. The increased regulatory focus on automation of credit life cycles and calibration of risk management practices of NBFC upper layer with banks and the strengthening of the scale-based regulations continue to drive volumes for FY24, with Q4 FY24 to be particularly high 80. We believe climate-related risks would significantly impact the regulated entities with potential long-term implications on financial stability. The regulator undertook targeted macro-prudential risk management measures to limit offtake of unsecured consumer loans and bank lending to NBFCs with significant unsecured portfolio. The outlook for this vertical continues to remain robust, with strengthened focus on revenue from consulting services such as review and development of ICAP, model validation, capital computation, sensitivity and scenario analysis, as well as stress testing. We see increased opportunities for cloud-based core models, scorecard models, and pay-per-use models from smaller NBFCs and for overall IL products and offerings. As regards outlook, structured internal rating solutions with workflow management and ECL solutions are in demand, and we expect that this segment will continue to do well in future. This is an update from IAL side. Thank you all very much, and I now hand over the call to the operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Hi, good evening. Congratulations on a good quarter. My first question is on the sharp EBITDA margin movement on Q-on-Q basis. I'm aware that in the previous quarter, we had this one-time provision of 8 crore pertaining to arbitration invoked by an ex-employee. But even adjusted for it, the margin delivery in this quarter has been pretty strong, with the absolute OPEX actually falling by 10 crore on Q-on-Q basis. So can you elaborate on this margin performance on a core basis and what can be the sustainability of the currently reported margins going forward?
Yeah, Rajiv, I think in the current quarter, in the previous quarter we had this one-off that you mentioned. In the current quarter, we had an impact on account of the finance charges. So this, if you see, we had acquired D2K in the previous quarter. And there is a certain amount of deferred payouts that we have to make to the promoters over the next 2 years. So we have accounted for certain percentage of that as a finance cost as required under Ind AS. So that component, if you look at the finance cost, bulk of that is coming from D2K. So if we adjust for that, yeah.
Sure. No, please go ahead.
So that's one-off which is, caught up in this quarter.
Okay, so one was a negative one-off in the previous quarter, which is not there in this quarter. But you're talking about that, deferred payment to the promoter, which has to be made to D2K promoters. That is now counted in finance cost. Is there any inter-P&L adjustment of cost or classification?
No. And the second part, when we are looking at an improvement, I think instead of looking at a QOQ basis, I think we should look on a full year basis because you will still have impact of certain expenses or a revenue which, can slip over from one quarter to another quarter. So I would, instead of looking on a quarter basis, I would say you look at a full year basis because even certain expenses like incentives which, can have a true-up impact in one quarter and another. So I would rather, instead of looking at quarter, I would suggest that you look at a full year basis.
Okay, that is okay. That is fine. But what you have reported in this quarter for Q4, it is without any one-off positive or negative, right?
So there's not much one-off in this quarter except the finance charges where you're seeing a bump up there.
Okay. No. So in my calculation of margin, that is basically below the EBITDA, right? Okay.
Yeah. In that well, yeah.
Yeah. And on knowledge services, we have seen further weakening of growth in this fourth quarter. So can you comment on trends in Moody's overall outsourcing volume, whether that has come off so significantly or whether our wallet share within that has been, lost? And is there weakness in any particular type of service line or particular type of work because we do multiple kinds of provide multiple kinds of services in knowledge within knowledge services. So just wanted some clarity on this slowdown and then follow up is whether when do we see growth coming back and that is the question.
Okay. Sure. Jesse, you want to pick up that?
Yeah. So on knowledge services, as you know, we have been servicing our global clients through this vertical, and there has been headwinds that we have seen in certain parts of the services that we offer to them. These are largely driven by the drive for automation that we are seeing globally, and that impacts all our clients. And obviously, they would like to automate the solution. To that extent, we do see some pressure which comes in. The way we are handling it is essentially we are looking at expanding our business and knowledge services to other clients globally as well as domestically. And we are also looking at growing our banking and risk management vertical business so that provides a counter to the kind of pressure that we see in the knowledge services vertical. Venkat, anything else you would like to add to that? Maybe you can add.
No, fine.
Yeah, and just one last question before I come back in the queue. When I look at knowledge services segmental margins, they seem to be resilient even amidst lower revenue growth in knowledge services. So what does it reflect? Does it reflect a higher amount of operating cost flexibility that despite, a stable revenue or despite even say slight decline in revenue, we are able to, work with the same EBITDA level in absolute terms?
So Rajiv, you're talking about a quarter or full year?
Venkat, when I look at last 3-4 quarters of revenue line of the knowledge services and even the PBT segmental PBT line, it's been pretty static while the growth per se has been coming off. So we are not seeing any negative operating leverage playing out despite growth coming to almost zero. So I was just trying to understand what is the operating cost modularity and flexibility here when the revenue growth is slowing down.
See, I think the question is, I think the segment itself during the previous year, this has been under some stress in terms of growth. So that is reflective. So the revenue, if you see, it would not have grown much. But the second part, when you're saying, obviously, it is a revenue linked model. So we have some amount of leverage. I would not say very, but we have a fair amount of leverage there. So in case there is, let's say, a role which is not there, we have the ability to scale down on the role. So that way, we have a leverage. And the second part is we own the real estate. So it's not that, so that cost is also not hitting us. So bulk of the cost, we have a leverage to adjust depending on how the revenue moves. So that's why you're not seeing a big hit there. But on a sustainable basis, if you ask me like 5 years, if we don't grow, obviously then there's a different discussion. But that's the reason precisely for the current year, we're not seeing much of a stress in the margin.
Got that clear. Thank you, and I'll come back in the queue.
Thank you very much. Next question is from the line of Balaji from IIFL Securities. Please go ahead.
I also had a question on the knowledge
Balaji,
services
sorry to
segment.
interrupt you. Can you please speak a little louder and from the handset?
Yeah. Am I audible now?
You're still sounding a little soft.
What about now?
Yes. Thank you.
Thanks for taking my question and congrats on a great set of numbers. So I have 3 questions, if I may. The first one is on, again, the knowledge services segment. So, one can see that your largest client, which is Moody's, they have been doing reasonably well as far as their 2 business segments are concerned. And I can also see that your own top line is a small fraction of their top line. So what exactly is resulting in this slowdown in revenue growth? That is number one. The second question would be on the current or the recent increase in risk weights for banks regarding their NBFC exposure. So will that mean that you will stand to benefit from that because typically the market-linked issuances have higher yield and margins? So that would be my second question. And my final question is more of housekeeping in nature. So could you quantify the revenue and EBIT contribution of D2K for the fourth quarter? Thank you.
So, Balaji, I'll pick up the first one and the third one. See, on the first one, I think your point is valid that, Moody's has got a fair amount of growth. Now, essentially, the way this market function is, most of the budgeting process typically gets covered in December, and they actually, freeze it last year itself. So, to which whatever performance that they have seen, it is possible that we may see a growth next year. I'm not saying committing, but we may see. So there is a lag which always happens. So but if you look at the previous year, they did have some challenges. That's part of the response.
There's some noise in the background.
And the second is in terms of viability. Now, why there is a challenges? Because the Moody's revenue has got 2 parts. One is
sorry to interrupt you. Balaji, while you're typing, can I request you to mute your line, please? Thank you. Sir, sorry, continue.
Yeah. So the revenue from KS has got 2 parts. One is what we call it as a full-time employment or an FTE billing, which gives you a static revenue. So that will grow normally. But the bulk of the majority of the growth for the segment comes from projects which come during the year. So in the last year, we did see some challenges in getting those projects, and that is a variable in nature. I mean, that's the nature of the beast. So we will see those kind of upside and movement, those kind of differences or gaps, depending on how we get the project revenue. So does that answer your question, Balaji? So there was a issue the previous year is the first part of it, and obviously there is some challenges for us as far as the new projects are concerned, because that itself has dried up last year.
Got it. Yeah.
And the third question, I'll just complete that. On the D2K side, I think we have not specifically called out this revenue as of now. Obviously, this will come later part in the annual report. So at this point in time, I'm not giving that information. But if you go to the segmental in the results that we have published, and if you see the risk part of the segment, the bulk of the movement that you would see, it's fair to say that would have come from D2K.
Got it.
Yeah, sure, for the second.
Balaji, I'll take the second question. This is on the increased risk weights on bank lending to NBFCs and HFCs. Yeah, you are right that with the increase in risk weights, we do expect some moderation in bank credit to this segment. Hence, these entities are likely to shift to bond markets for their funding needs. So what is likely to happen is the larger entities and the ones with better ratings would find it easier to tap the bond markets, whereas the smaller entities would need to look at securitization more than what they've done in the past. So we're already seeing those trends, but ultimately it also depends on the overall sentiments, how the consumption trajectory pans out and to what extent the NBFCs and HFCs are able to grow. But yes, you are right that I do expect a somewhat better traction on the bond side as well as on securitization.
Okay, so if I can have a quick follow-up on that. So while this might show up in the volumes, will that show up in revenue? Because, so basically to put it another way, are most of these NBFCs on fee caps?
Balaji, I'm not able to hear you clearly, sorry.
So are most of these clients on fee caps so that, you may see an uptick in volumes but not necessarily in revenue?
Yes, I see. No, see, look, one is securitization is never covered under fee cap. Secondly, while some large entities, particularly those who issue large volumes, do come under fee cap, but we also are quite mindful of, the amount of debt they raise and they increase, each year in terms of their funding requirements. So the fee cap also gets reset on a frequent basis. So as the BOD goes up, the fee cap also gets reset.
Got it. Thank you, and all the best.
Thank you.
Next question is from the line of Varun Bang from Bandhan Life Asset Management. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. So the first question is on the risk consultancy services segment. So firstly, how has been your initial experience with D2K technologies, if you can comment on that? And secondly, how are our platforms in the risk consultancy services different from what is currently there in the market? And what is our strategy to scale risk consultancy services segment? This is the first question.
Yeah, Varun, I'll take that. As far as our initial experience with D2K is concerned, it's been very positive in the market. As you know, the organization has been in the market for almost more than 20 years, and their products are really something which are at the cutting edge in terms of technology. We see a strong demand from D2K on three verticals. First is on credit monitoring, second is on regulatory reporting, and third is on data management. Now, all these services which they provide in terms of software solutions to banks are actually timed very well because the regulator is also moving quickly on these areas where they need risk monitoring and regulatory measures on reporting are getting tighter and tighter. So we are seeing increasing demand for their products, especially on EWS, IRAC, asset classification, end-to-end automation, etc. And initial reaction to answer your question would be very, very positive. As far as our automation solutions go, I think the platform question that you had, we have, automated a lot of our solutions in the internal risk scoring system as well as the ECL systems which we provide for the banks. And we constantly take feedback from clients as to which areas of these products need upgradation. And there is a lot of technology that gets deployed in these products to upgrade them on a continual basis. We have recently upgraded to a newer version of internal risk solutions which we call IRS3, and that has received very strong acceptance from the market. We are similarly upgrading other platforms as well, and we believe that IL products would be in tune with the technology movements which we see in the market. Maybe Shubham, if you would like to add anything on D2K.
One moment. Shubham sir, you may go ahead.
Yeah, thanks, JC. So definitely in addition to what JC has said, so with the acquisition of D2K, our product suite on the risk and monitoring has got completed. As JC was saying that IL already had tools like IRS and ECL, and then D2K is very strong on the monitoring bit with its EWS and the asset classification tools. So what value add we are also providing to the client is the end-to-end cycle for their entire loan portfolios, where instead of going to different vendors, they can come to IL and we take care of the entire cycle. So that is becoming a good USP and DTM for our products overall. And then platform, yes, currently most of the products from D2K as well as IL are on-prem because of regulatory requirements also. But for some other segments like AMCs, etc., now we are creating lighter versions of our products, which may not be on-prem, but possibly operate as a SaaS model.
Just for the benefit of everyone, Shubham Jain is our group head of strategy.
Varun, do you have a follow-up question?
Yeah. So the second question is on the knowledge services segment. So in our PPT page 17, we have talked about increasing focus towards insourcing by our partners. So if you can just share more insights on that, that would be helpful. And what is driving this shift, and is this a temporary phenomenon?
Sorry, can you repeat that question?
So in our PPT page 17, in the knowledge services segment, we have talked about increasing focus towards insourcing by our partners. So if you can share more details on that, that would be helpful.
So I will pick this up. So I think that's the general trend that we have seen in the outsourcing where they have a captive. So when we talk about knowledge services, I think apart from our holdco, we also have some other clients, and we did see in our experience in the last year that some of the services that they had given us, and this includes non-Moody's as well. I mean, we have clients outside Moody's as well. They were trying to do it through their captives, but this is a general trend that we have seen in the industry. And we also, that's very clear that Moody's has got their own subsidiaries across the globe, and when we actually bid for
Ladies and gentlemen, please stay connected. The line for the management dropped. Participants, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. So you may go ahead. Your line is reconnected.
Yeah. So thanks. I think I don't know where I lost, but I will try to. So when we actually try to bid for assignment, even with for the clients at an international level, there's always a fair amount of competition that we have with their captives. I think this is an industry-wide risk, nothing very specific to us as well.
Okay. And if you can just share the revenue mix between project business and FT, or let's say recurring business, and what rate is the recurring business going for us?
That information we are not sharing, even in the annual report. So to maintain parity of the information between all shareholders, we'll not be able to reveal that.
Okay, no problem. Lastly, one suggestion. I appreciate the steps that our organization has taken over the last couple of years, and it's good to see some progress. But one of the areas where I still see some gap is the return ratios. And if I see a return on equity, it is less than half of CRISIL, and that is because of the excess cash that we are holding. I think we should be targeting higher return on equity, and I had suggested the same thing in the last phone call. I would suggest management to seriously look at the same.
Sure. I think it's a fair point. And just to reiterate that the capital allocation is something which we review constantly. And in the previous year also, we had actually looked at this. From a payout perspective, I think we upped the dividend last year. This year also the dividend we have upped. And we also did an acquisition last year. So when we actually look at the allocation, we try to strike a fair balance between what we want for expansion and what we want as a payout. But I think your point is very much valid and well taken.
Okay, thank you.
Thank you. Next question is from the line of Abhijit Sakare from Kotak Securities. Please go ahead.
Hi, good evening, everyone. So the first question is on expenses. So initially, I think there was this comment that there's been some investments towards capability building, infrastructure. So where are we on that journey as of now? And if you would like to indicate going forward, is the pace of investments going to decline, or there is still some more room to cover there? That's the first question.
So there are two parts to this. One is, of course, spends as far as people are concerned. That obviously is a core part of our capital, if you like, and that will be, of course, the significant corrections that we have to make in terms of aligning our pay structures, with the market. Bulk of that, was done about a year or two ago, and now henceforth going forward, it will be just the normal, annual corrections that one would, expect to see. Where we will continue to see spends over the next, 2 to 3 years, essentially will be in the technology area. This is an area where, we have to naturally invest in infrastructure as well as enhancing the quality or efficiency of our applications to improve user experience both internally and with respect to our external users. So that's an area where we will see spends, but we have naturally a roadmap, and we are done with probably about a year and a half, 2 years of that journey, and then we have another few years to go. That will continue till the time we are satisfied or till it reaches a normalized kind of a level, and thereafter the spends will be what one would expect to see on a recurring basis.
Sure. And between ratings and non-ratings, is there a skew where you had to make bulk of the correction?
Given the nature of the businesses, naturally, from a people standpoint, the bulk of the corrections had to be made. I'm talking about in absolute terms, had to be made, in the ratings area, because that's the skill set of the people that we have, in the ratings world. In the non-ratings business, particularly in the knowledge services area, which is where bulk of our people are, housed in our subsidiary, ICRA Analytics, there, in fact, the pay scales are, lower. And that's, again, that's the nature of that industry as well. So the people investments, bulk of it, did happen in ICRA Ltd, and that will essentially be the case, even going forward. Though, of course, going forward, as I said, we expect those changes or increases to be, fairly, modest or normal. With respect to technology, I would say, it would be, slightly more skewed towards ratings. But having said that, there are spends happening within the non-ratings area as well.
Got that, sir. And then finally, to finish this point, on the rating side, when we benchmark your margins, they do look on the lower side. The exact comparison may not be possible due to how you allocate expenses versus others. But clearly, should we see this number inching up quite nicely over the next few years if the rating revenue growth sort of sustains where it is today?
I think, directionally we are headed well, and this is something that we have been keeping an eye on, because we are, as you yourself would be aware, a little behind where we were in best of our years, in the past, and we are actually moving, towards that. It's probably not reasonable or fair to compare our margins, with some of our competitors, because the construct of each one of these organizations is quite different. So one doesn't really know how the cost allocation happens or where the resources, etc., are housed. But having said that, margin improvement is something that we are extremely sort of, preoccupied with, and this is an area that will continue to receive, our attention all the time. And it's, I think, fair to say that directionally we are satisfied with the progress that we have been seeing year after year.
Okay. And then second one, on the non-rating side, Venkat made a couple of points on the Moody's business and how you have to incrementally sort of compete harder. In fact, even on the non-Moody clients as well. And then initially there was also comment about the willingness to expand inorganically. So are there any big areas where we need to clearly cover some ground and make some inorganic acquisitions over the next maybe 1.5 years?
We will remain opportunistic, and the most important thing for us is to ensure that the opportunity that that we choose to pursue will have to be synergistic with what we do as a group. So fundamentally, it has to be in the risk analytics space or research, which is actually aligned, with what we're doing. So synergy is what we will be most, first about or particular about, and we will continue to remain opportunistic. So the opportunities are interesting, naturally, we will pursue those opportunities. But the intent is for us to grow the non-knowledge services business in terms of scale.
Got that. And the last
correction. Sorry, one correction there. So it's not that it has become hard this year. So it was always hard. So getting business from and bidding with the having the other subsidiaries as a competitor was always there. So I heard that comment saying incrementally it has become hard. No, it was always hard actually.
Sure. Well, thanks for that. And the last is a data question. What is the employee count, and if you can break it up between the ratings and others? Thank you.
So the employee count, I think, roughly would be on 1,350 plus, and bulk of them would be on the non-rating side. So roughly,
You would say about 800 in the non-ratings area and 450 in the ratings area.
Sorry, the last year we were at 1495. So has the number gone down this year?
No, sorry. We would be at 1,500 because we have to
including the
So bulk of that, out of that 400, 450 would be, it's a high level number, would be at the rating side, and the balance would be at the non-rating side.
Okay, got it. Thank you.
Thank you very much. Next question is from the line of Ravi Purohit from Securities Investment Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I have a slightly long-term view, and my question will be slightly longer on that. So if we look at over the last 10 years, right? Out of the last 10 years, there have been 3 years where we reported double-digit revenue growth, and 7 years were probably flat or low single-digit growth. CRISIL, on the other hand, has probably done the reverse. 7 out of the 10 years were double-digit sales growth. Now, over the last 3 years, of course, we've delivered double-digit sales growth in every year, and we've also kind of invested a lot on capabilities and abilities. Now, my question is, in the long term, how do you see this business? Right? Moody's is a very, very growth-oriented organization. Do we have constraint to growth, or when you look outside, because the rating business in India is you can grow only so much, right? It's a very, very small market. So over the next 5-10 years, how do we see growth? Where does growth come from? Is our business constrained by options to grow? Is what I'm trying to understand. Or when you kind of look at businesses over the next 3 years, 5 years, do you actually see opportunities for us to deliver double-digit sales growth continuously for the next 5 years, 10 years, right? What, something like CRISIL has done over the last 15 years in India. Because S&P is invested, they have 67% stake in CRISIL, so they've ensured that the company kind of continues to deliver growth.
There are two parts to this. One is the ratings business. And the ratings business will always be range bound in terms of growth because it is a regulated business. So what we do, what we can do, will always be dictated by how the regulatory framework evolves. And besides that, it's always a leverage play on the economy in terms of the credit, activity, if you like. So that is one part of it. The other part of it is the non-ratings business. Our intent as a management team is to ensure that we have a book that is reasonably, de-risked, if you like. So either from a concentration standpoint, it could be the client concentration or business concentration. So which is the diversification that we are working on at the present time or we have been working on for the last couple of years. And that is the intent with which we are keen to grow the non-knowledge services business, because the knowledge services business is actually heavily Moody's dependent, if you like. So, and even the acquisition that we made towards the end of last year in the non-ratings, space, the acquisition of D2K Technologies, that again is consistent with our strategy of growing the non-ratings business. So as a management team, our desire is to ensure that we have a very diversified book, which will ensure that we have, essentially growth, that is acceptable to us and to the street on a consistent basis. So that is our endeavor. That will continue to be our endeavor.
Okay. So, if we look at Moody's, somewhere towards the end of 23, they had launched an AI tool, right? AI based research tool for their end customers, right? Because of course, research agencies, both CRISIL and ICRA or S&P and Moody's globally would have access to incredible amount of data, right? Both on credit side, on companies, performances, and time series of long data. They have launched this tool to kind of monetize that data. Does ICRA fall in that kind of ecosystem? Do we have enough systems and in place to kind of integrate into that? And is ICRA kind of working towards monetizing the kind of data that you would have accumulated over the last 15-20 years in India? And just an aside, I think we saw on LinkedIn there was a post which says ICRA will now be called as an affiliate of Moody's. What does that really mean for ICRA? So those are my two questions. Thanks.
Right. See, the first question, naturally, we will be guided by the regulatory framework. There are certain things that with certain points of data that we have, which we cannot monetize because we are precluded from from being able to monetize it regulatorily. But we also have data which can be monetized, and those are all opportunities that will be pursued through ICRA Analytics to the extent they are regulatorily, permissible. And that is, all those initiatives and, opportunities will be pursued, and all that is part of a larger strategy that we have to grow the non-ratings business and to diversify our book, from a revenue standpoint. With regard to your question on us being called a Moody's affiliate, this is just rebranding at the group level at Moody's. It doesn't change anything, from our standpoint, from the point of view of us being, a subsidiary, of Moody's or being part of the Moody's group. So it is just a branding, and this is something that's being done, globally by Moody's, and which will be uniformly applied to all the entities that they have within their fold across the world.
Okay. Thank you. I'll get back in the queue. Thank you.
Thank you. Next question is from the line of Kunal Tanvi from Banyan Tree Advisors. Please go ahead.
Hi, thanks for the opportunity. In the start of the call, we talked about some challenges with the Moody's business because, they have been trying to automate their, work. Can you throw some light on this? Does it also play into, lower projects coming to us? And what are the kind of automations they are trying to do, and how, as ICRA Analytics, are we also part of the journey in terms of helping them, automate processes? Is this automation an opportunity or a challenge for us, from a longer term perspective? That is question number one. The second is, we talked about FTE and the project business, project business not being, we not getting project last year. So is it right to assume that FTE business, we did not see any drop off in terms of revenue, it continued to be steady state without any incremental growth, and projects dried up, which could come, say, in FY25 or 26, depending upon, the pipeline from Moody's?
So thanks, Kunal. I think from your question, the first question was whether, the AI is a threat or an opportunity. I think it's a mix actually. So for the industry itself, if we look at it, people are having different perception, and from our perspective, we think it is both a threat as well as an opportunity. Opportunity in the sense, what essentially happens is there are a lot of transformation projects which keeps on happening. So fair amount of chance that, if we do it right, if the pricing is right and everything goes right, we may be a part of that transformation project. And having said that, the AI will also have its own. See, the way it works is, you have a set of work that you do, which is largely on the data side. People keep on automating that. So you, as a model, you evolve and you get more on the higher end of the work. So that transition will be possible, and it's an ongoing process. But having said that, the AI, if you would have seen generally for the kind of industry that we are in, most of the people have identified that as a long-term threat. So the business model obviously has to evolve on an ongoing basis and figure out a newer projects within the system. So that's the first question, I think. And what can you come back on the second question, Kunal?
So it was on the FTEs and the project, right? If you see the knowledge service business last year, that is FY24, is it right to assume that the FTE business was, continuing steady state and projects did not come through, and and the growth lever for years to come would only be the project business?
Yeah, it would be fair to say that we were hit more on the project side rather than on the FTE side.
Sure. And the second question was on the market services and, risk management, while because of the 2K, we saw a strong jump in the risk. But when I look at the profitability of these businesses in the segment, data, they are barely making money. Can you talk about, our profitability aspiration in this business? What are the numbers that we are looking at? Because as we've been giving commentary on, high focus on growing non-Moody's, non-rating business over the next 3 to 5 years. Great if you can talk about the profitability of that you have in mind.
So I will not talk about specific,